Welcome back, everybody, to the second episode of the Global Investor Podcast. Now, I want to thank everybody, first of all, for all the feedback from the first episode. I did get a lot of emails, a lot of positive responses on Twitter, saying good job, they enjoyed the episode. So thanks for that. But I do want to remind you that you can also give me negative criticism. It's fine, I have thick skin. Believe me, this isn't something that I'm really going to defend myself against. I understand I'm not very good at this, so please help me out and give me some negative criticism, because from the first episode, really the most negative things that people were saying, and it was actually kind of funny, it came up several times. I had a little piece of green tape here holding the wire to the mic stand, and I had about 4 or 5 emails saying, you got to get rid of the green tape, it was super distracting, they're trying to watch me speak and their eyes keep darting over to the tape. I had no idea it was there, and I wouldn't have known if anybody didn't say anything. So that's kind of the point of the feedback. Feel free to do that, but also you can definitely go beyond just, green tape or what I look like. Go ahead and say what's on your mind. But let's get right into this. I'm going to divide it up into 2 segments today. A little bit later on, I'm going to do a little deeper dive into the VIX index, talk about what it is, talk about what those values actually mean, because I think a lot of people talk about the VIX, and we certainly hear a lot about it. But sometimes I get the feeling that people don't really know what it is, or perhaps what it could be used for. So I'm going to get into that in more detail. And to start things off, obviously current events are going to have a major role in these episodes going forward. So it's pretty difficult for me to open this without talking about the fact that we technically in the S&P 500 may, or I will get into, may not have gone into a bear market. So let's get into that. Thank you very much for tuning in to the second episode of the Global Investor Podcast. So for a market recap, we have to talk about the spectacular crash we saw in the fourth quarter of 2018 in the S&P 500. It was a very significant down move, and we actually haven't seen a move like that in quite a few years. So caught a lot of people off guard. It was pretty scary when it was happening. But let me pull it up in the Thinkorswim platform and we can talk about it. So this is a 1-year chart of the S&P 500. This white line is still drawn from where we started the year in 2017. And you can see right there is the hash line ending 2018, substantially below. So this was actually the first year since the financial crisis that the S&P 500 on a total return basis was actually negative. We haven't seen that since 2008. But right here, starting at the end of September, all the way down to Christmas Eve, is a massive crash that was about 20%. And this is where we're going to get into the technicalities. Because if you look at these numbers that are highlighted, these are both intraday prices. So on an intraday basis, from 29.40.91 all the way down to 23.46.58, that's slightly more than 20%. It's about 20.2%. But for anybody out there who likes technicalities, if we look right here on September 20th, 2018, it actually closed on 29.30.75. That was the highest print. And then on Christmas Eve, on December 24th, we closed at 23.51.10, which if you run the numbers on that, it's actually a decline of 19.8%. So this is where you get the back and forth on Twitter where people are saying, oh, it was a bear market for stocks, it's finally happened. Other people are saying, well, technically not really. Honestly, none of this matters. It's just definitions. We're talking about a fraction of a percent here. If you're a buy and hold investor, which I hope you're not, I'm going to talk about that a lot in the future, why being tactical is definitely far better than buy and hold. But if you are a buy and hold investor, would you really care whether you were down 18, 19, or 22%? At that point, it's kind of all the same. The overall point is that it was a significant decline of about 20%, and it was a little bit scary because if I actually back out on a 2-year chart here, what we can see is that nearly took us down. Right here is the December 24th low. That nearly took us back to the inauguration and beginning of 2017. So I will find January 20th, 2017. The S&P 500 closed at 2271.31. And again, the low just recently was 2351.10. So we were only 80 points away from retracing the entire move of the last 2 years. And given how markets are moving around lately, 80 points is basically one day. We were one bad day away from retracing all of the gains since Inauguration Day at the beginning of 2017. That is a significant decline. Now, it's bounced a little bit recently, which is encouraging. The last week, it's seen a little bit of a bounce. But to be honest, that's to be expected when you see a decline that much. Some of the best periods for the stock market are immediately following some of the biggest crashes. So we're going to have to give it a little bit of time to determine what direction we're going next, but at the very least, it's a little bit encouraging that the bleeding has stopped, at least temporarily. But that 20% decline number is pretty relevant. The only thing it really means is one of the charts that I've been showing for the VTS community over the years is something that I may not actually be able to show in the future. This might be the last time that I can talk about it. What this is the top 7 longest bull markets in history, and I've defined it as a period of a less than 20% S&P 500 close-to-close market decline. So in this respect, at least from the stock market's perspective, we are tied for the longest bull market in history. Now, for all those technicality people who are going to say it's actually declined 19.8, it really doesn't matter. But one thing I like to remind people of, something that I say quite a bit, you've probably heard it said in many other places as well, but it's important to remember that the economy is not the stock market, and vice versa, the stock market is not the economy. So we could go back and forth on this one, whether we're technically in a bear market for the stocks. I think one thing's pretty clear. We're definitely not in a recession when it comes to the economy in general. Now, one will come. Obviously, that's inevitable. At some point, it's going to happen. But when I look at the metrics right now that we typically use to determine these things, I think it's pretty clear that the bull market in the actual economy is still alive and well. The first metric we'll check out here, this is the S&P 500 earnings, inflation adjusted, going back many years. And you can see over here on the right, everything kind of looks okay. Earnings in 2018 were pretty strong. And obviously the strength of the companies out there, this is rather important in determining whether the economy is strong or not. And as of right now, everything looks fine. We are coming into earnings season soon. We'll see how it goes. I'm thinking it might come in a little bit weaker, but only time will tell. All we know is right now, earnings do seem to be okay. The second metric we can look at is United States GDP growth. So this is the US real GDP growth. That's the nominal GDP minus inflation. And we're sitting right now at about 3%. That's nothing to write home about. It's definitely a little bit below the average since 1985, but it's comfortably positive, and I think that's important. Now, again, this is just one of those definition things, and everybody's definition will vary a little bit, but something you'll hear said quite a bit is a recession is marked by 2 consecutive quarters of negative GDP growth. So I personally think it's a little bit more than that, but it is hard to make a case that we're in a recession or heading towards a recession when real GDP growth is still 3% year over year. And the last metric, which of course is also a very important component, is the job market. So this is the U.S. non-farm payrolls, net monthly change since 2000. And again, we've been positive for many months in a row now here. You can see down here I highlighted the previous record for the most consecutive months with positive job growth was 48. And right now we are sitting at 98 consecutive months of job growth, so completely smashed the old record. Going back to October 2010, we haven't seen even a single month with negative job growth. Until we see this decline, I'm not really sure a good case could be made that we're in any kind of trouble right now. So this is all semantics, but I think it should be pretty clear that as of now, the economy seems pretty strong. Now, that certainly doesn't mean that it's going to stay that way. I talked about red flags. There's a lot of headwinds. We do want to pay attention to certain things. And one thing that I personally will be paying close attention to going forward, kind of a strange situation. So during the crash, the S&P 500 is down almost 20%. Everybody's kind of panicky. Nobody really knows what to do. How long is it going to last? Is this the big one? And Steve Mnuchin, the Treasury Secretary, now this is completely unsolicited, mind you. He didn't respond to questions. It wasn't in response to articles that were being written. He basically just thought this was information we should know. He came out publicly, and I'm paraphrasing, but essentially what he said was, don't worry, folks. I've contacted all the major banks, and they all assure me that liquidity is just fine. Now, when somebody says something like that, totally unsolicited, it definitely gets you thinking, what is his motivation for coming out and doing that? That would be like, imagine you were in an argument with your wife or your husband, and to make amends, you want to cook them a really nice meal. So you're in the kitchen, you're slaving over this meal, it took you a long time to prepare. Everything looks good. You set the table, you light the candles, you pour some wine. The setting's great. Right before she takes a bite of the food, you say, now, you should know, I didn't use any expired food products in any of this preparation. You're definitely not going to get sick when you eat this. Please enjoy. And she would look at you like, I wasn't expecting to get sick before you said that, but now that you mention it, those eggs were looking a little bit old. And boy, I hope you didn't use that old can of condensed milk that I didn't throw away last year. Your head starts to really go through a little checklist. So when he said that, don't worry, folks, bank liquidity is just fine. I'm thinking, well, it wasn't on my mind before, but now that you mention it, bank balance sheets don't really look that fantastic right now, and interest rates have gone up, so that's certainly going to matter at some point. And, the stock prices themselves, they don't look very good either. So let's take a look at some of those stock prices. Here we're just checking out some U.S. banks for last year's performance, and we've got, Goldman Sachs down 35%, we've got Citigroup down 28%, Morgan Stanley, Wells Fargo down 23%, Bank of America down 16.5%. These are really terrible numbers. And we can look at European banks, and it's actually an even more grim picture here. We've got Deutsche Bank, just looks like death in 2018, down 58%. BNP down 42%, ING, Credit Suisse down 38%, UBS down 32%. These are really awful numbers. So when he comes out and says, don't worry, folks, everything's fine, I think this is a red flag, and we should add it to the list of things that we're going to be paying attention to going forward. But, like I said, certainly as of now, the economy seems fine. It was a very substantial crash, so, we're not out of the woods yet. Down 20%. That's the biggest decline we've seen since the European debt crisis, all the way back in 2011. And like I said, we haven't seen a negative year in the stock market since 2008, and we just had one. So these are all things to keep in mind. But that's the market recap. Hopefully things are improving a little bit. It is looking like a little bit of a recovery is underway, but earnings season coming up, we're just going to have to see how things go. So during this latest stock market crash, a lot of people out there, including myself, were talking about how the VIX index was relatively calm considering the magnitude of the move that we saw in the S&P 500. Down 20% in a relatively short period of time. Typically, we would have seen the VIX index much higher than it actually got. Now, I talk about the VIX index a lot, and it's probably one of the most quoted volatility metrics out there. But recently it also occurred to me that many people may not actually know what it is, but they may also not want to really ask about it because, maybe out of embarrassment. It's like back in school. Maybe you're in physics class and the professor's up talking about, planetary rotation and orbits and gravitational pulls, Newton's laws. Nobody wants to put up their hand and say, okay, great, I understand all of that, but what's a planet? Nobody wants to go back to the very beginning and ask those basic questions out of embarrassment or whatever. But the thing that we learn is the chances are pretty good. If you have a question, then other people are wondering the same thing. So today I thought I would do everybody a solid, not make you ask for that. I do talk about it pretty much every day, and at this point, people probably don't want to say, well, by the way, I don't really know what this is. So I'm just going to go ahead and talk about it, and I want to cover a couple of basic points. The first is, what is the VIX index? I'm going to actually explain what it is, and then secondly, what do those VIX values actually mean? So first of all, we're going to start with a basic definition. So the VIX index, more properly known as the CBOE Volatility Index. CBOE stands for Chicago Board Options Exchange. And a basic definition is as follows. Calculated based on a strip of S&P 500 options, the VIX index measures within one standard deviation the forward one-year expected movement of the S&P 500. So that's really all it is. For all of the mention in financial blogs and the financial media out there, it's really just a representation of forward expected returns on the S&P 500 based on market activity in the options market. Now, one thing you may have heard several times about the VIX, oftentimes it is called the fear index. And the basic reasoning for that is most of the option activity on the S&P 500, at least the hedging activity, is on the put side, on the downside, people protecting portfolios against a significant drop in market value. So typically we see more action on the hedging put side rather than the speculation call side. And this is one of the points that I really want to hammer home, because fear index gives people the wrong impression. It leads people to believe that it is actually an inverse relationship here, where if the S&P 500 is crashing, the VIX spikes up, and if the S&P 500 is calm, that must mean the VIX is very low. When in actual fact, you can look at this definition, and there's no upward or downward bias anywhere in this. The VIX index is completely directionless. It is only measuring forward expected movement, plus or minus, and that is very important. Now, it is true that the correlation between the VIX index and the S&P 500 is negative. So what we're looking at here is the rolling correlation between VIX and SPX. SPX is the S&P 500 index, and this goes all the way back to 1990. So the long-term rolling correlation is about minus 70%. Remember, correlation doesn't imply magnitude. It simply means that if one of them is going up, if there's a negative correlation like we see here, it typically means the other one is going down, and that happens about 70% of the time. But it is valuable to know that that's not necessarily the case. There are many periods, especially on a shorter time frame, where both of them move in tandem. The VIX and the S&P 500 can both go up, or they can both go down at the same time. If we break this down into just a 5-day chart, it's a little bit messy to look at, but you can see that here, that the correlations are here on the left, and while the long-term average may be about minus 70 on this bottom line, you can see that there are several periods on a 5-day window where correlations are nearing 100% positive. So that would mean that every day the S&P was going up, the VIX was also going up, or vice versa, both of them going down every day for a 5-day period. And that happens quite often over history. One of the more pronounced examples of this that I like to show people is back in the late 90s when the S&P 500 was raging higher. This is the dot-com boom where pretty much everything was going straight up. You can see the performance here. 1997 up 33%, 98 it was up 28, 1999 it was up 21%. Very consistent, very strong performance. So if the VIX index is the fear index and we are looking at a period where the S&P 500 is very smooth and performing very well, then most people will be under the impression that the VIX must have been very low during this period. Maybe something similar to like we saw in 2016 and 2017. Very good stock performance, very low drawdowns, and a VIX extremely low, historically low. But actually what we see, I've got a chart here showing all of the VIX index mean values. This is the average for the whole year. And you can see I've highlighted 97 to 99. The VIX index was actually averaging values around 24 during that period. So much for the fear index, right? Those are some of the highest values we saw on an average level, and yet the S&P 500 was performing extremely well. In fact, the annual returns for these 3 years were substantially better than the previous 3 years that we've seen recently, from 2016 to 2018, yet the VIX recently is far lower than it was back then. 2018 was a negative year for stocks, and still the VIX index had a mean of 16.64. That's below the historical average, and way below these values that we saw at the tail end of the dot-com run-up. So it's really important to understand that stable markets doesn't necessarily mean a low VIX. And the reason is because let's say you were trading volatility products, right? You were trying to trade VXX or UVXY, and you're using your typical S&P 500 technical analysis. You're looking at moving averages, everything looks fine, very low drawdowns, it's very consistent. Maybe you've got your MACD and your Bollinger Bands, whatever it is people are accustomed to using. But that might actually work in some environments. Like in 2017, for example, it would have worked very well. But it's not necessarily going to work in all environments. And like I showed, from 97 to 99, it perhaps may not have. And this actually applies to all areas of the market as well. It's very important to understand what the metrics actually mean, because in stable markets, when everything is cooperating and all of the correlations and all of your indicators, everything's behaving normally, well, anybody can perform well in that environment. As they say, everybody's a genius in a bull market. But as soon as the market throws you a curveball and does something unexpected, that's when not understanding what the metrics truly meant could actually be financially costly. So long story short, basically that's what the VIX index is. most important thing to understand is that it is non-directional. It is just a forward expectation of market movement based on options activity. And like I said, it's plus or minus, so keep that in mind. Now I want to get into what the numbers actually mean. So I'm going to pull up Thinkorswim here, check out the VIX index right now. And you can see right now it's trading at 1950. Just for simplicity today, I'm going to go ahead and say it's trading at 20. So great, the VIX is 20. But 20 what? What does that 20 number actually mean? So in the case of the VIX, the 20 is actually a percentage. Some people think it's a price, maybe it's $20. It's actually 20%. And I've got a little slide here that should clear that up. So remember, the VIX value is the market's expectation for 1-year S&P 500 movement. So for example, like I said, I'm going to use 20 today. A VIX of 20 means the market expects the S&P 500 to move plus or minus 20% over the next 1 year. If we want to know what the forward 1-month expectation is, we can actually take the value of the VIX index, which in this case is 20, and we can divide by the square root of 12, representing 12 months in the year. And that square root is 3.46. So the VIX of 20 divided by 3.46, that means the market expects the S&P 500 to move plus or minus 5.78% over the next 1 month. We can also go down to 1 week and use the square root of 52, which is 7.21. And in that case, the market expects S&P to move plus or minus 2.77%. You can do this over any time frame. So what typically people do is 1 day. Now, it is important to remember that the VIX calculation is a calendar calculation. It's not actually trading days. But when I go down to 1 day, I do typically use trading days, which on average, there's 252 of them. So the square root of 252 is 15.87. A VIX of 20 implies that the forward expected movement of the S&P 500 is plus or minus 1.26% per day, per trading day. Now, I've got a quick chart here that I can leave here, and you can always reference back to this video. You can pause it on the screen. It'll basically tell you a quick breakdown of some general VIX index prices, and you can scroll over and see 1 year, 1 month, what is it implying over 1 week and 1 day, etc. So just remember that this is here, and you can always reference back to it. So just to give an example of how to use this, and tie it back to the fact that I originally stated that I felt, and many other people felt, that the VIX index was a little bit low considering the magnitude of the crash we saw in the S&P 500, the average VIX value in December was 24.95, essentially 25. So we can look at that column here. Now a 25 VIX is implying a 1-month move of about 7.22%, and remember that is plus or minus. But the S&P 500 was actually down over 9% in December. And if we look at the average true range of the S&P, which is a good metric, I suggest people start using it, because it does take into account intraday movements and the highs and the lows for the day. But the average true range was extremely high, again showing that the VIX index was a little bit muted given the magnitude of the crash. So hopefully now you understand what the VIX index actually is and what those values mean. So like I said, you can reference this chart if you like, or you can get used to actually using those square root calculations. They're pretty simple. Just memorize the basic ones, square root of 12, square root of 252, and you can go ahead and do those calculations yourself. So the next time you're at a dinner party and somebody chimes in and says, you know, the VIX index is actually overpriced or underpriced, you can now chime in and say, actually, based on my own square root calculations, I think the VIX index is actually fairly priced where it is right now. I don't know, do they talk about the VIX index at dinner parties these days? I don't get out much, obviously. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.